You can master technical indicators like the VWAP and the 200-period simple moving average. You can memorize candlestick patterns, and yet you can still hemorrhage capital. Look at these two waveforms. They represent the exact environment where most traders are wiped out. The root cause of that failure rarely stems from bad indicators. It comes from a specific analytical error known as time frame dissonance. This happens when a trader applies aggressive trend-following tactics during a counter-trend market phase. When you try to catch tops and bottoms during these dissonant phases, the result is mathematically predictable. You get liquidated. You are trading against the dominant institutional momentum, mistaking a short-term fluctuation for a macro reversal. Surviving the market requires completely abandoning the urge to predict price movement. Instead, your sole objective is to synchronize the higher timeframe institutional order flow with your lower timeframe execution.
To do that, we have to establish the timeframe hierarchy. The higher timeframe acts as the uncompromising dictator of the market. It determines your objective bias and tells you exactly what institutional order flow is doing. This split-screen visualization illustrates the hierarchy in action. On the left, the higher timeframe dictates the macro swing. On the right, the lower timeframe internal structure is volatile and chaotic. The lower timeframe is entirely stripped of predictive power. It serves only as a mechanical execution trigger. When you combine them, you see that price action is never random. It cycles systematically through a predictable four-phase matrix. These four phases are defined entirely by moments of harmonic resonance, where the timeframes align and point in the same direction, and periods of dissonance, where the lower timeframe vectors clash against the macro trend. Mapping these four phases will permanently eliminate the trap of trying to catch a falling knife. It gives you a rigid framework to systematically align your entries with institutional algorithms. We map these conditions using a 2x2 phase matrix. As you can see illuminated in the top left quadrant, we start with phase 1, the baseline. In phase 1, we have pro-swing and pro-internal alignment. Both the higher timeframe and the lower timeframe structures are printing higher highs. The vectors are moving in perfect parallel. This brings us to the golden rule of probability. Phase 1 is the only environment where aggressive, trend-following execution is mathematically justified. Institutional flow is entirely synced across timeframes, putting the highest volume of capital directly behind your trade. But that harmony eventually breaks. Moving to the top right quadrant, we enter phase 2, the reversal trap. The diagnosis here is clear. The macro higher timeframe trend is still solidly bullish, but the short-term lower timeframe momentum has just broken structure and initiated a counter-trend pullback. This is where retail capital bleeds out. Traders see the short-term drop and attempt to blindly predict the exact top of the structure, or they try to front-run a reversal that hasn't actually been confirmed on the macro scale. This requires a strict capital protection protocol. The tactical command for phase 2 is a complete ban on blind entries. You do not touch the market until a definitive liquidity sweep and a confirmed market structure shift, or MSS, manifests on the lower timeframe. Phase 1 requires aggressive capital deployment to ride the aligned trend. Phase 2 demands algorithmic patience and strict capital preservation while the market digests the initial pullback. Once that pullback is fully established, we transition to the bottom left quadrant, phase 3. This is the counter-swing and pro-internal phase. The phase 3 diagnosis dictates that the lower timeframe is officially bearish to facilitate a pullback, while the fundamental higher timeframe bias remains stubbornly bullish. You are now operating inside the counter-trend. If you choose to execute a counter-trend short in this environment, you are operating under a severe tactical constraint. You must ruthlessly limit your targets. Notice the horizontal thresholds below the price action. Your profit targets must be anchored strictly to higher timeframe discount zones, specifically a Fibonacci retracement greater than 0.5, or key structural levels like the VWAP or the 200-period moving average. You have to execute with precision because the lower timeframe structure is highly likely to abruptly snap back to the higher timeframe bias the very moment these deep discount zones are tapped. Phase 3 is a high-risk interception zone. Your profits are artificially capped by the inevitable return of the dominant macro trend. Get in, hit the discount zone, and close the position. Finally, we reach the most psychologically demanding environment on the board, the bottom right quadrant, phase 4. The Phase 4 diagnosis is that price has successfully reached an extreme higher timeframe discount zone. This presents the mathematical opportunity to rejoin the main trend and ride the macro momentum. But the danger is severe. The lower timeframe internal structure is still actively printing counter-trend lower lows. If you buy blindly here, you are stepping in front of a moving train. To safely intercept price, you need a specific execution trigger. Look inside the discount zone. You must wait for the lower timeframe internal structure to break its bearish sequence and print a confirmed market structure shift. That entry is only valid once a 5-minute candle body closes completely beyond the key level. This is not about anticipation. It is about waiting for physical proof that the buyers have overwhelmed the sellers. Surviving Phase 4 means letting the market vote with a body close before you risk a single dollar of capital. Once that shift is confirmed, the dissonance ends and you transition safely back into Phase 1 harmony. Understanding the 4 phases of the matrix is useless without a binary logic gate to enforce your execution. You need a mechanical filter to keep you from trading on intuition. The first filter in your logic gate isolates the macro environment. You identify the uncompromising higher timeframe bias based strictly on whether the price is currently sitting above or below the 200 SMA and the VWAP. The second filter analyzes the lower timeframe action. You are verifying whether a 5-minute candle body actually closed beyond your key level, or if it merely wicked through the line in a deceptive liquidity sweep. Routing every potential setup through this specific logic gate neutralizes emotional tilt. It reduces discretionary reactive trading down to pure data processing. This brings us to the final uncompromising analytical protocol. This diagnostic overlay must be completed before you deploy capital. First, you explicitly define your current market phase based on the matrix. Then, you document your alignment status, isolating exactly what the higher timeframe swing and the lower timeframe internal structures are doing right now. Next, you formulate your tactical plan and risk parameters. You demand of yourself a stated objective and a designated mechanical action. Are you riding the macro trend aggressively, or are you waiting for a structure shift at a discount zone? Finally, you enforce an anti-tilt warning. You create a custom psychological reminder designed to protect you from the specific trap associated with the market phase you just diagnosed. This is how professional order flow is captured. Remove subjective prediction entirely. Demand structural alignment before execution.